Thank you. So my name is Alain Dubois. I'm in charge of product management, product development for MSCI. And I will try to have an angle for this presentation, which is more to talk about our business. What do we do? What do we do for a living? What is our business? And to begin with, I will just take a very simple example. You invest into an equity fund, for example. And let's assume you invest in an equity fund that is based on European equities. Then the first year, the performance is like 10%. So you're very happy about your asset manager. He performed extremely well. And then the second year, the performance is, I don't know, minus 4%, for example. You say, oh, he's a bad manager, so I will sell my fund. And this is typically an attitude which is still very much the attitude of retail investors. But then we arrive, and as index provider, we provide some benchmarks. So what do? We say, okay, you have a fund which is a fund invested in European equities. I will take the MSCI Europe, which is an index that is representative of investment in European equities. And I will say, well, your first year you did 10%, but my index did 12%. So actually your asset manager performed 2% less. So he was not that good. So yeah, in fact, he was not so good. And then the second year it does minus 4%, but my index will say, well, the performance of my index was minus 6%. So in fact, your asset manager has been better than you thought. Yeah? And this is typically what we do with indexes. I mean, our business is basically to provide transparency to the investment management process. And this is really what we do every day. And we do that with a lot of research. And if you extend this example, which is a very simple example, to the, I mean, in MSCI, we produce 160,000 equity indexes every day. And in the whole industry, the whole independent index industry, we produce approximately 1 million of indexes, of equity indexes every day. So this is, if you extend this, you will see that everything we do is there to increase the transparency of markets and the transparency of the investment management process. And by the way, one of the side effects of this is cost efficiency. I mean, sometimes people ask the question, what has been the major innovation of markets during the last 50 years? You know, there is a traditional answer, which is to say nothing. In fact, there is nothing that has been really, there is no real innovation beyond the automatic teller machine, you know. In fact, an important innovation is the development of indexing, benchmarking, and that has led to incredibly more efficiency of the asset management process, lower cost, the development of markets like ETFs and all that. All this is linked and would not have happened without an independent index provider. This is really what we do. You know. Now, I wanted to enter a little bit in more details. I look at the time because I want to respect my 10 minutes. And to describe a little bit how all this is working, because you have a lot of, it's not very clear here, I mean the color is not very good, it's too much light. Okay, so you have some providers that are providing the basic data that are used. You have the stock exchanges, you have also a lot of OTC trading data. You know that, for example, bond indexes, I mean, the bond trading is OTC. You have also declarations, because in some indexes you don't have any trading at all, so you need declarations in order to base these indexes. And you have also a lot of other data. I mean, there is no index that is based only on stock exchange data, for example. You always need, just to classify companies, for example, you need a lot of data. You need to look at their accounts, whether they are a company that is doing real estate or something else. There are some criteria, some classification, all this you use. Then you have a whole profession of data aggregator, validation, recalculation. Sometimes, you know, for example, if you take bonds, I mean, you have only, for most bonds, they are traded only once a month or once a week. So you need to recalculate their value. Then you have the benchmark research and the calculation, which is what we do. So we input a lot of research, and then we build these benchmarks. And then you have the asset manager, and then the final investors. So all this data, I mean, it goes from the basic data to aggregator, to benchmark provider, to asset managers, and to the final investors. And the flow of money is more the other way. So the final investors pay the asset manager pay the benchmark provider pays the data aggregator, and the data aggregator are paying the rough data. It's more or less the structure of the industry. One important thing is what makes all this all together, and this is this slide. That's intellectual property. You know, at the end of it, all this is working because of intellectual property, because each agent in this chain has a right on what it produces and can be paid for that. Yeah. So intellectual property is really what makes this independent index providers live. It's what makes all these data providers live independently from others. And if you destroy or if you reduce the weight of this intellectual property, it will be more and more difficult to have independent index provider. So what you will have is vertical integration. And vertical integration, you can have a sort of classical vertical integration, which is the stock exchange model, stock exchange indexes, where you combine the data that you have from your stock exchange, you combine that into benchmarks. I will not enter into the detail of this model. But then you have another model, and which is developing very much, which is self-indexing. And self-indexing is a combination of the asset manager and a benchmark provider. And when you think at it, it is something which is very prone to conflict of interest, because what is benchmarking? Benchmarking is mostly evaluating the performance of the asset management. So it's like if, you know, I mean, it's a nice situation. I will come to see my boss and I will say, you don't need to evaluate me, I'm evaluating myself. You know, it's, but here, I mean, it's, I'm evaluating myself. I create a fund and I'm evaluating the performance of this fund according to my own criteria with my own benchmark. So this is something which is basically prone to conflict of interest. And what is extremely remarkable is that self-indexing was nowhere mentioned in the initial document of the EU Commission concerning the benchmark regulation. I've seen nowhere self-indexing, which is something which is developing, which is very much prone to conflict of interest, and nobody talks about it, you know. And that is something that I wish to mention here, because, I mean, this is something that is. I mean, after all we are talking about is conflict of interest. I mean, the LIBOR issue is conflict of interest. All the issues that has concerned very much the public authorities is linked to conflict of interest. And here we have one major conflict of interest, which is developing. And more importantly, there are some projects today to exempt asset managers when they do their own indexes, to exempt them from the regulations. So not only this is allowed, but on top of that, there are some projects to exempt them on the ground that, for example, asset managers are already regulated. So because they are regulated, they should not be regulated according to benchmark regulations, even if they produce some benchmarks, which I think is not normal. I mean, there should be at least an equal playing field, and everybody in the industry that are producing benchmarks should be treated the same in terms of regulation and should have the same constraint. I mean, this is how a level playing field works. And also there is one other way where this type of exemption could work, which is to say we regulate only the big indexes. The major indexes that are used as benchmark. We don't regulate the small benchmarks. But the practical effect of not regulating the small benchmarks would be that self-indexing will be exonerated. Because if you do self-indexing, you will do one index for a specific fund. So you will have as many indexes as funds. So you will have, each index will tend to be small. This is in a way the contrary to benchmarking, which assumes that you have some indexes that are widely used by several funds. So there is some attempts of non-regulating self-indexing on the ground that either this is made by regulated entities or on the ground that these are small indexes. So this is something that I wanted to mention. And I think I've now reached my 10 minutes. So that will be my conclusion. Thank you.